Some people say that the Chinese economy is about to collapse due to its zero COVID policy. Others say that the equity market in China is now uninvestable. So in this video, we look at why it's sticking with its zero COVID policy despite all the political unrest and economic damage, and also potential ways out of that crisis. And we also look at whether the equity market in China is now representing an opportunity. So let's look at whether China's economy is about to collapse in a bit more detail. So what are China's problems right now? Well, what people were discussing until recently was China's weak property sector, which made up about 25% of GDP, either directly or indirectly, and it imploded over the course of this year as some very big names went bust. What people have been talking about more recently is the zero COVID policy and all of the protests across China as it locked down big tier 1 cities. Now, both of these factors are fairly closely under control by the Chinese Communist Party. So by changing its policies, potentially it can find its way through these problems. However, the third factor is not under China's control, and that's slowing global growth, which will negatively impact China. Now, if we look at Chinese GDP, that's the top panel you can see beside me, there was a big jump after COVID, but now that's largely subsided, and we've had several quarters of weak year-on-year growth. The dashed red line you can see here was a 5.5% target that China had until recently, and we're well below that. Now, some people don't trust the Chinese GDP numbers, so instead they look at the year-on-year increase in the price of copper, and that, as you can see, has been negative recently. Why copper? Well, it's because China buys over 50% of global production, and its growth tends to be very copper intensive. Now, what's been causing all the recent problems is this surge in COVID cases, which you can see in a geographic map beside me. Notice that a lot of these outbreaks are in tier 1 cities, and that's a problem because these produce a lot of Chinese GDP. Now, there's a recent report by Nomura which shows that the lockdown areas represent about a fifth of Chinese GDP. Also, there have been big protests in response to the lockdowns. So it seems as if Chinese citizens are very fed up with the lockdowns and the curtailment to their freedoms. And it's led some people to call for the end of Communist Party rule. Now, home ownership is very widespread in China, and so it's particularly shocking that house prices have now been falling for almost a year. In fact, in October, there was the largest year-on-year fall that we've had so far in Chinese house prices on average. Now, that's going to have a wealth effect on people because when people are more worried about house prices, they also tend to spend less. And it's also likely to cause some unhappiness amongst the populace because nobody likes to feel poorer. And it is Chinese Communist Party policy which has led to a clampdown on developers. So regulators recently have noted the dissatisfaction and they've come up with a 16-point plan to sort out the real estate market. So, for example, there have been some policies which allowed some developers to issue state-guaranteed bonds. But generally, if you look at forecasters such as the IMF, the International Monetary Fund, they've said that their GDP forecasts for China have been reduced due to worries about the zero COVID policy. So the IMF has reduced its 2022 forecast down all the way to 3.2%. Now, it used to be the case that there was a crisis if China's growth was below 5% or even 6%. So clearly, this is a problem for China. Now, the only reason the forecast increased to 4.4% in 2023 and 24 is because it thinks China will relax its zero COVID policies. But this isn't just a short-term problem. There's also a structural long-term problem here with China's growth, which has been great if we compare it to the US. So the US is this red line with black dots here at the top, but you can see that China, at least by one measure, has exceeded it if we look at GDP in purchasing power parity terms. However, if we look at GDP per capita, this is the amount of GDP generated per person in China, you can see that China's very much in the EM range down at the bottom. In the US, each person generates over $60,000 of GDP. In China, it's well below 20,000, depending on how you measure it. So it seems as if China's caught in a middle income trap where its wages have gone up and that makes it less competitive with other countries. The only way to break out of that is to compete in the high value added market. That would be for high-end goods, such as mobile phones or electric cars, or maybe even software. So the US ban on Chinese technology, which has been mirrored in many other countries in the West, is going to be a problem to break out of this middle income trap. Why is China sticking with its zero COVID policy given all the problems? If we look at the daily caseload, at least according to the FT here, you can see that the caseload's comparable to the previous outbreak in spring of 2022. Now, on the face of it, the vaccination rate looks pretty high in China at around 91%. But the problem is the number of people who are elderly who are vaccinated. That's very low. So if we look at people 80 and above, only 20% of them have been fully vaccinated with 3 doses. And if we look at what happens if the population's not fully vaccinated and you remove restrictions and zero COVID policies, as happened in Hong Kong recently, you can see the effect, which is a huge surge in mortality. And you could argue that Hong Kong was much better resourced for these kind of crises than China is. And China has a similarity with the UK in that it has very few intensive care beds per 100,000 population. The UK had 7.3, China has 3.6. So if there was a wave of COVID cases that spread through China, its intensive care capacity simply couldn't deal with it. So the only real solution here is to have a widespread vaccination program for the over 80s. And there are some signs that China is trying to encourage very old people to get vaccinated. Could the zero COVID policy work? This is data from the National Health Commission in China, and you can see that the cases have spiked a lot recently. Now, many people think this has already gone beyond the point at which it can be contained, given that the new variants of COVID are much more contagious. So, for example, Francois Balloux, who's a geneticist who's interested in epidemiology at UCL, says that the COVID situation in China is not looking good, and that the authorities have trapped themselves into a situation from which there's no obvious escape. And whatever they choose or are forced to do next will be very costly. He thinks that the most plausible scenario is that there's going to be a big COVID surge in the near future that leads to massive morbidity and mortality. And this will be amplified by a collapse of the entire healthcare system. Now, we already saw the shortage of intensive care beds in China. That's presumably what he's referring to. And he also says that it's now almost impossible for the government to backpedal on this zero COVID strategy because they've invested immense political capital into the policy already. However, I think that the scale of the protests may have taken the government aback, and perhaps it will start to backpedal on some of its policies quietly as a result of those protests. So, for example, one of the policy changes could be to import mRNA vaccines, which are more effective than the Sinopharm vaccine, which is produced by China. Or perhaps it'll develop its own mRNA vaccines, which are more effective. So personally, I think the end game will probably be something like a limited reopening, such that people who've had 3 doses of the Sinopharm vaccine are exempted from any kind of lockdown. And in order to protect old people who are unvaccinated, they simply have to be sheltered. Perhaps the Chinese government can do this without losing face. But I think the government's very unlikely to stick with a policy of widespread lockdowns because it simply is causing too much economic damage. And it's causing so much political unrest. Now, before we move on to the question of whether the equity market in China is now uninvestable due to all those problems, let me quickly show you one of the tools which is available if you're a member of PensionCraft. I've added these quite recently, and you probably see that it's similar to the graphs I produce in my videos. But this is interactive, so you can select any period you want and look at the risk and return over that period. Or perhaps you want to look at the cross-asset returns. So here you can see the country returns, and you can see that China is basically flat over the period since 2008. So if you do want to learn more about our membership, just go to our website, PensionCraft.com. So should investors avoid China or invest in China? Well, certainly if you look at the risk and return over the last 11 years or so, China's added very little to the global equity portfolio. So here you can see I've got life strategy funds in the UK. These dial up the amount of global equity from 20% up to 100%, and they also dial up the risk. So this is 100% equity, 0% bonds, and this is 20% equity and 80% global bonds. And here at the top, you can see the S&P 500. Now the x-axis here is the volatility or the risk of a portfolio, with high risk on the right, low risk on the left, and on the y-axis we've got return. So ideally, you'd want high return and low risk. And all of these life strategy funds hug that top left corner of the risk-return plot. And the S&P 500 also looks very attractive because it had high volatility, but also high return. And that's despite the recent drawdown. But adding anything with the name China in it over the last decade would have reduced your return and increased your volatility. So really, this is the worst of both worlds. What's also interesting is there is quite a bit of variation between different China funds. Generally, you'd have been better off with domestic Chinese shares, or A shares as they're called. And if it was denominated in sterling, you'd have benefited from sterling weakening over this period of time. So historically, recently, China's done very poorly. And if we look over the period of the pandemic, you can see that China sold off less than the US. So the S&P 500 is shown here in blue, the CSI 300 China index is shown in red, but it also had a huge rally just like the US did. However, it turned around before the US, and the sell-off has been deeper than it was in the US. But you might argue that the turnaround may also come sooner than it does for the US. Another positive that China's got going for it is that it's very cheap. If you look at the price to earnings multiple, which is shown here from Yardeni, compared to other EM countries, Brazil's cheaper at roughly 7 times forward earnings, but China, which is shown in green, is at a 10 times forward multiple. That compares very favorably with its own history and looks very cheap. But of course, it's cheap for a reason. But if you are a contrarian, that may be an attractive prospect if you can live with China's politics. If you want emerging market exposure without China, it's going to be tricky because China makes up such a large proportion of EM. Now, iShares EM funds use MSCI indices, and MSCI is a little bit odd in that it classifies Taiwan and South Korea as emerging market countries, which hardly anyone else would. So here's the MSCI Emerging Markets ex-China ETF. You're going to have huge exposure to these 3 countries, India, Taiwan, and South Korea, 2 of which are not emerging market countries at all. But still, if you do want EM exposure without China exposure, it is possible to get that. In conclusion then, I don't think there's much doubt that Chinese growth will be weak, and a large proportion of that weakness is coming from its zero COVID policy. However, as investors, if you are contrarian, it's certainly also true that Chinese stocks are now very, very cheap. And that means if there is a subtle backtracking on the zero COVID policy, there could be a lot of upside for Chinese equity. However, there are huge risks that go with investing in China. And we've seen, for example, the recent political instability. There's also the question of what's going to happen to Taiwan. And of course, the government could clamp down on any sector at any time and declare that it can't make a profit, as it has done previously. So if you are going to invest in China, you should be very well aware of those huge tail risks. So given those tail risks, I'd be pretty cautious about a very large exposure to China right now. But those valuations look very attractive if you're contrarian, and China exposure would fit with your ethical stance. Now, don't forget our offer. If you do want to join our membership, there'll be a link beside me and in the description beneath me, which will give you access to those tools and lots of other goodies like members-only videos. And as always, thank you for listening.